Hello, everyone. We will probably wait for a couple of more people to join us. But before this, please look in the chat or maybe in the Telegram chat. Here is a link. I want us together to go through one quiz and discuss some topics from yesterday. So please go through this link, and then we will. Then I will start the quiz and we will all see questions simultaneously. Yeah, I see many people are coming. By the way, if you're not comfortable with other people seeing your name, it may happen maybe in the end. I'm not sure, but it probably will happen. So you may use whatever, I don't know, numbers, letters, fake names, and so on. And I'll share my screen so we could all see, or those of you who don't want to connect for some reason, so we could all see what's going on. No, this is like a quiz, just for me and to understand how well did you understand what we discussed yesterday, and just for everyone to to retake the yesterday's material. So it's not graded, and the course, it's not graded. So no worries about any grades or something. Just to discuss yesterday topics. Okay, we already have 23 users in the quiz waiting. Okay, we have 24 people. Let's wait for one more person. Oh yeah, here we are. Okay, I'm now starting the quiz, and I didn't use this system before, but as I understand it works, we will all see the same question simultaneously. So here it is. Okay, I'm starting the quiz. Please, let's discuss and answer the question 1. You can see the question, the first question, right?
Yes.
Thank you.
And it's the same as yours, so it's okay.
Okay. So 19 people voted out of 26, I guess. On this question, I'll wait maybe until either everyone votes or it will be 1 minute or so. I think one person left. Maybe not. Okay, yes, you can see my screen and the shares of answers, right?
Yes.
Thank you. So yeah, that's right. The marketplace where you can trade, for example, shares, but not only shares, it's called exchange. Okay, let's move to the next question. Sorry, here is the correct answer, yeah, exchange. Next question. What is the intermediary which provides access to the market for individuals and companies. I'm now wondering if I should keep sharing my screen because maybe the most popular answer confuses everyone. Here is something in the chat. Can you send the link? Yeah, sure. But I'm not sure actually at which state you will find it. Guys who are a little bit late, did you manage to join the quiz? Okay, good. Okay, I think it's time to see the results. And here they are. And the correct answer is, of course, broker. Broker is an intermediary which provides us, individuals or companies, the access to the market. Yeah, Ivan, Ivan, sorry, it's a private message. But yeah, I'm wondering that I'm probably shouldn't share screen because it's the most popular answer is seen. It confuses everybody. So let's now try. I'll stop a demonstration of my screen and I'll only share the results every time. Okay, next question. So key interest rate is defined by central bank, market, commercial bank. Oh yeah, it's better without sharing a screen. But not much. That's a good thing. Okay, and now I'll share my screen back. So you could see the distribution of answers. So we have 30 watts. Still, it's quite biased, but at least there is some distribution of answers compared to the previous questions. Okay, the key interest rate is defined by central bank, of course. It translates us later to the economy because the key interest rate is a rate at which banks can take loans and provide deposits to the central bank itself. So that's how central bank translates its rate to just simple individuals, other companies, and to the whole economy. Okay, next question. What could be a measure of the country's economy size? Okay. Everyone or almost everyone knows the answer. The correct answer is GDP, which stands for the gross domestic product. Yeah, which is indeed a share of, or no, share, the measure of country's economy size or the country production size, etc. Yeah, okay. As you see, almost everyone voted for this variant. Okay, I'm stopping my screen sharing again and going to the next question. The last question is what would be a better investment option for an individual who is not willing to take much risk and wants to stay more conservative? Okay, that's great. We have again. I'm sharing back my screen forever. Uh, so you see that again, most people voted for bonds. Yes, indeed, bonds have a fixed payoff, so it's quite predictable. However, it guarantees that we do not get just we don't get lucky and get just some super high upside. So that's a pity also. But you need to choose between risk and return. Here you can see that most people, at least half people, probably uh, have done half of their task, not half, everything correctly. So that's good. Now I'm finishing the quiz and we can start. So you can close this quiz link. Thank you for participation. This was a good try of the system. Sorry, do you see that recording is on, right?
Yes.
Okay, thank you. Yeah, I see. So today we're going to talk about hopefully two short topics. We will start discussing the standard banking products and related concepts, and then maybe we will come to the to things that we can face on everyday life in finance. So I guess some of you may find this class more or less easy. I mean, maybe many of you already know things that we will discuss. So please feel free to participate in the discussion. And still, I think it's important to discuss those things because they are indeed like basic. So almost everyone, or probably everyone in the 21st century has to deal with banks and banking products. So and there could be quite a lot of underlying risk, and it's important to remember about them and to account for them. So before we start discussing the products themselves, please let's discuss such an important concept. We will come back to it later all the time. It's called time value of money. What it's about? Assume that you just won $1,000 in the lottery. So you're probably very happy. You got lucky. That's a good thing. And just imagine how would you feel about it. And then imagine that you are said by this casino or some center when you got it that you will only get it in 1 year. So you are probably not so happy about it now. And also try to imagine what if you said that you'll not get them in 1 year, but you will get them, for example, the sum will be divided equally in several parts, and you will be paid it gradually over 5 years. So over 5 years, this is 60 payments of $1,000, so it's not really much for each month. So probably you would matter, right? You wouldn't say, okay, I don't matter. You can give it me today. You can give it in 1 year. It's absolutely the same. So probably you would feel the difference. And the question is why is it important?
Because money loses its value with time.
Yeah, you can call it like this. Yeah, yeah, because actually $1 today and $1 in 1 year, it's not the same thing. Yeah. First of all, psychologically, but for us, for of course, most importantly, that it's not the same thing economically, financially. So, what does it mean? I'm thinking how to approach this. So what is this time value of money? How to measure it? How to measure this difference between present value for today and value in 1 year or in 2 years, in 1 month, and so on. On what we can see, this time value of money is reflected in interest rates. That is actually why interest is paid on different instruments, including term deposits and loans, which we're going to discuss today. And you probably all in general know what it means. And that is also why investors are willing only to invest in some assets that will bring some return. And this return should be high enough. So it's not just, I don't know, not everyone would agree for low percent. You will always compare to the market average and so on to estimate that time value of money is compensated enough. Okay, and here is another question. How exactly can you estimate present value of $1,000 that you'll get in 1 year if your interest rate is 10%? Any ideas?
We should multiply $1,000 on 1 minus 0.1. So you like in 1 year you only get like $900 value.
Yeah, this actually computationally this would be close, but I'm not sure about how you approach this. So just mathematically, the number you'll get is close to the correct answer. So that's how you would, how you should think of it. That you know that you will get this 1,000 in 1 year, and to estimate how much it costs you today, you should answer the question: how much money can I afford to borrow today to pay it off in 1 year when I get my 1,000? Including the interest that will be accrued to this amount. And if you assume the interest rate, let's assume that they are the same, you know, for all products in the economy, you understand that you will have to pay exactly this amount multiplied by this coefficient. So let me write it down directly. For example, so you know that here is some x that you are trying to find, the present value of this future payment. And you know that if you borrow this money today, you'll have to return in 1 year this amount of money. So the principal value, which is that's how called the initial amount that you borrowed or lended, and some interest rate. And you also want this to be equal to the sum of $1,000 you're going to get in 1 year. So here how this formula was born. Is it clear? And in this case, as Ivan stated, this would be approximately indeed, I don't know if Ivan meant this or not, but this would be just approximately mathematically in this particular case, this would be close to this. But this is just arithmetically, that's it. Any questions? Okay. I'll delete what's written. Okay, and in such context, usually this interest rate is referred as discount rate. We'll also use this definition, maybe not today, but please remember this for, especially for the investment part. Okay, one more time on interest rates. We already discussed interest rates at first yesterday, but now let's remind ourselves what we discussed. So interest rates, they are different for different currencies. They depend on time period money is borrowed for. So if you borrow money, for example, for 1 month and for 1 year, the interest rate will probably be not the same. Also, they depend on some risk factors, like when you borrow money from a bank, they'll estimate how risky you are for them, and they may either refuse to give you the loan at all, or just if they see that you're not good and repaying loans, they see you as a high risk person, and they'll just increase the interest rate to you. Or there could be many more things that could underlie the risk factors, but this is just one example. This could be some internal reasons of the bank, if we're talking about bank products. For example, if there is some crisis and a bank needs money like really much, just needs them to survive the current moment, and they may increase interest rates like very, very much. For example, I remember during the economic crisis of 2014 and 15, and even in 2016, some banks, they just got deposit interest rates up to 30%. So this could be the reason, because they just needed money really much. Also, interest rates can be fixed or floating. We will not discuss it much today. Fixed interest rate, it means, for example, you depositing your money or you're taking a loan and you said, okay, you're gonna get for it like 5% interest rate fixed. And floating interest rate, it may be, for example, every month the interest rate is reconsidered and is set according to the key rate, for example. It's also possible, or some other indicator. And another important thing, I'll remind you again that interest rates are always stated in the annual terms. So if you said that, for example, the interest rate for you, if you invest money for 1 month is 10%, it doesn't mean that in 1 month you will get 10% more than you invested. It will be adjusted according to the share of the year you invested your money. Any questions on interest rates? Good. So let's now discuss two major ways of interest calculation. There are two major types of interest calculation. The first one is called simple interest. It's called so because it could also be called differentiated interest. At least in Russia, it's more common to call it like differentiated interest. And in this case, it's based. Oh, sorry, I'm lying to you. The simple interest is based only on the principal amount. So, and compound interest is based on the principal amount and the interest rate already accumulated. So let's consider the example. So I understand that just word definition could be not clear. What does it mean? What is the main difference? The main difference is that in compound interest, when you invest your money for some long term, you have some intermediate interest payments. And in simple interest, you just got those payments and that's it. And in compound interest, those payments, they are added to the main principal in your investment, and like it's going to be interest on interest. Let's consider an example to make it more clear. Assume that you deposited $100 for 5 years at 6% interest rate, and that interest rates are paid every year. And the question is, what is the amount you will be paid back over this period? For the simple interest, so I'll write it down. For simple interest, you invest 100 now, and you'll have it back in 5 years. And also every year you will be paid 6% of this sum. So this one for the first year, also 6% for the second year, and so on. So as a result, you can just multiply this by 5. So just 5 payments of 6% of your, of 6% of your initial amount. And for compound interest, every time you got interest, this interest is added to the amount of your deposit. So this would be a little more complicated. So it would be something like you will have to get your initial investment back. You will have to get you'll get 6% in 1 year. And for the second year, it's already not so so simple, because you will get again another 6% of your initial amount, but after the first year, there would be already additional $6 you got as interest after the first year. So you'd have to add it like this. So, and for this payment will also be added for the next year, and so on. And actually, this would be the same as just multiply an amount that you have initially for 106. And you see that the amount you get paid in the end is different. So when interest is accumulated and compounded, you'll get, because of this interest on interest part, you'll get a little bit more. Any questions on this part? Okay, here I made some plot, some graph or some chart to make this difference even more obvious. So for short terms, it could be not so clear, but the longer the term is, the more it matters what type of interest compounding you have. Because as you see, for compound interest, it almost, I don't know, so if you invest for 4 years in our previous example, for 40 years, for this previous example, you would have a difference in several times. So this is very substantial. If you're wondering what it could be that for that you would invest for 40 years, I don't know, maybe some long-term investment like for retirement or something like this, or just very long. There are some long instruments which allow you to actually invest for such a long time, like corporate bonds, for example, some of them. Okay. I just want, we continue to the next slide. I want to emphasize this definition of assets and liabilities just to use those words later and to make sure that we are all on the same page. So assets, as it may be intuitively clear from its name, assets is what you have, like resources you have. It's your income, it's maybe your real estate, maybe some savings you have, etc. And a liability is vice versa. It's what you're obliged to pay. It may be loan payments, education payments, something that you need to buy regularly, like food, transportation, and so on. Just to make it clear to everyone. Okay, now let's continue to the actual bank products. And we will start with the most popular banking product. It's called current account, or checking account, or transaction account. It depends on the context, on the country, and on your preferences. So current account is just an account which everyone has who has a banking card to pay with. I'm sure every one of you has it. So what does it give? What does it give us? First of all, it's immediate access to the money. You can access your money anytime you want. So it's not just some, some gold in the safe or something like this. This is just something you may access every time you want. You may withdraw cash in the ATMs. You can simply every time you use your debit card is you're using your current account, for example, buying food in the supermarket and paying with your debit card. Also, when you do transfer of money, electronic transfer of money to your friend, you're also using your current account. And the feature of current accounts in the interest rate on the current account, money of current account is usually around 0%. It could be either 0 or something like 0.01, like really small or nothing at all. So as you may guess, it may be not so beneficial to keep a lot of money in the current account. So it may be not so important for students, for example, but at some point of life, we will probably have, we will, as school tech graduates, we will become rich and successful, and then probably it will be more painful if you earn 0 interest rate when you can do it like, I don't know, at least 5. So current accounts. Now let's make step higher and talk about term deposits. Term deposit or just deposit is when you place your money in a bank, you specify the term, for example, 1 year, and the bank will pay you some interest. So just a simple deposit. Probably also everyone knows about this product. If you're not familiar, please ask questions. So this just, you give your money to the bank and bank return this money to you in some period of time with some additional interest or percent of your initial investment. And this interest is usually fixed in the beginning. So let's consider another computational example. Assume that you deposit $1,000 and 4% interest rate for 3 months, and assume that interest is simple, as we discussed, just not compounding, and assume that interest is paid in the end of the period. And please let's take a couple of minutes. Okay, maybe let's take 1 minute to calculate how much money you will be paid back in 1 month, and then let's discuss. And please type what you got in the chat. And for those of you who is lazy to like completely make it by yourself, I provide you three variants of choice. So you can, if you don't want to calculate yourself, you may just estimate it somehow and vote in the chat. Still no options. Anyone do have maybe someone can explain with the microphone how to approach this question? I'm sure that for some of you it may seem very simple, but at the same time I'm sure that many people would make a mistake in this task, including me when I started learning about deposits and interest rates. So you can hear me, right? Interesting. How are you doing this? I didn't know there was an option to write on the screen for students. Cool. Yeah, Ivan, thank you. Everyone can see what Ivan wrote on the screen, right? It's not just me.
Yes, and it's also in the chat, the right answer. So.
Oh, really? For some reason, I cannot see. Cannot see it. Probably because Ivan is drawing something. Yeah, now I can see it, I guess. Yeah, every answer is, yeah, now I can see the chat. Sorry, for some reason I couldn't access it. Yeah, all answers are correct. That's exactly how Ivan wrote it here. So the important thing is that do you know how can I erase this? Yeah, thank you. And here it's how it's calculated. The important thing is that when you are given an interest rate, you should always remember to account for the term. So the interest rate is always in annual term, and you should adjust it to the term you're investing money on taking a loan. So, okay. Let's consider another example. It's also a simple one. First of all, the important thing, especially about Russian deposits, for in Russia, by law, any individual person can cancel the money he or her deposited and withdraw the money. So the bank cannot to forbid you to take your money back. They can just say, we will not pay you any interest, but they cannot take your money away from you for long term. It's not the same for companies. So if you are a huge company, that probably the bank may say, okay, sorry, your money is ours for 3 months, because it could be a substantial stress for bank to pay back such a big amount at once. But for individuals, you can come, at least in Russia, probably in other countries, sometimes it's the same, but definitely not at all countries. So you should check it if you're doing term deposit in different country. So let's consider such an example. Let's assume again the same $1,000 and 4%. Let's now assume that you deposited money already at 4% for 9 months. And again, interest rate is simple, it's paid in the end of the period. And if you cancel the deposit, you lose all interest which is accrued to this moment. So, and in 3 months, the market condition changing, the central bank changed the key rate, everything changes on the market, and deposit rates for all terms, for all short terms, go to 6%. And you're considering, should you continue with the old deposit, or you should just withdraw all your money, or lose accrued interest, and deposit money again under new interest rate? What do you think, and how to approach it? And maybe someone can calculate it really fast and type it in the chat, or maybe just say it.
As far as I'm concerned, it's the same.
Yeah, that's right. That's the same, and that's how it looks like. So you see that if you keep your deposit, in the end you will get interest of 4% for 9 months. So it would be 9 over 12 here. At the end it would be $30. And if you reinvest, but at higher percent, but for a shorter term, because you lose your previously accrued interest, it will be the same. So no point of changing your term deposit strategy at this example. Any questions? Okay. Features of the deposit. So what to pay attention when you are choosing how to deposit your money. First of all, it may be type of interest rate. It may be fixed, it may be floating. As I said, it may depend on, for example, central bank key interest rate. Usually it's fixed, so usually they don't offer you such an option, but sometimes it happens. And for example, if one day you are responsible for some company, it may also happen. You may ask them to provide you floating interest rates. So just remember there is such an option possible. You should pay attention in what type of interest rate compounding you have. It may be simple or it may be compound interest. And in Russia, I think it's almost always compounding interest rates. So when you're paid some intermediate interest payment, your interest continue to accrue on interest on interest. But I'm sure it's not always like this. So pay attention. It's important, as you saw this, on this chart of 40 years investment, the difference could be quite substantial. Also, what's important, it's if you have an opportunity to add money to your deposit during the life term of the deposit. Not all term deposits have such an option, neither in Russia nor in other countries. So probably if you want to be able to add money to your deposit when it's already open, you will probably get a lower interest rate. Why it can be useful to have such an option? Because, for example, you think that interest rates in Russia are very attractive right now. So they're cool, they're high. Maybe maybe not now, but at some point you will think like this. And you want to make sure that you, for some time, you'll have an opportunity to invest under such a level of rates. And for example, if you have term deposit for 1 year and you're afraid that, okay, maybe interest rate may drop, maybe something will change. So you want to make sure that you always have such an option in the year ahead. So you may worry about this opportunity to add money to your deposit and to keep this level for you fixed at least for 1 year. The same works for the opportunity of early withdrawal. As I said, in Russia, it's possible. For individuals, it's always possible. For companies, it may be not possible in Russia, but for individuals, according to our law, civil law, probably it's called. Okay, I'm not sure how this specific law document is called, but on the very high level of Russian law, it's stated that all individuals must have access to their money anytime. And the important thing, especially for Russia, because we have such a feature, when you deposit money in some country, it makes sense to check if you have some insurance. For example, in Russia, all term deposits for individuals are insured by the government if the sum is under 1,400,000.
Excuse
So,
me.
yeah.
Is it important where we have a deposit in rubles or in dollar, for example? Is it still be insured?
Yes. All individual deposits are insured. Yeah, that's right. You mean in Russia, right?
I mean, like in Russia, we may choose, for
Yeah,
example,
yeah, sure. Yeah, in
a
Russia,
ruble
every
deposit on.
yeah,
Yes.
in Russia, every individual deposit is insured. In other countries, if you deposit in other currencies or even in rubles, it's not. It may be not like this. But in Russia, all deposits under this amount of money are insured. So if something happened to your bank, there is a special government agency of deposit safety. I'm not sure about the correctness of this translation. Агентство страхования вкладов, and they will pay you those money back. And under some special circumstances, it can be even up to 10 million. But don't hope for this. So here are some special requirements for this case. Okay, let's continue to loans. Bank loan is in somehow opposite to the deposit. It's not when you are not a lender but a borrower. So bank loan is when bank is lending money to some individual or organization. And now it's a loan taker who agrees to pay some interest to the bank. So loans also have a set of features that you should know of. Let's discuss them. There is such a there may be such a person or entity for in loan documentary as guarantee, and guarantee is a usually person who pays the borrower's loan if something happens to the borrower or if the borrower cannot pay himself or just fail to pay, I don't know, or if the borrower is irresponsible. Why does it make sense to ask someone to be your guarantee? Because in general, loans with collateral allow you to use lower interest rates for loans. For example, here is a simple example. You may be offered 5% loan in a bank, but if you find a good guarantee, for example, you ask your friend to be your guarantee, and your friend has like brilliant credit history, he has a very successful career and high income, and bank sees it, and they may lower your interest rate to 4%, for example. They often they even state in the initial terms that, for example, here are our terms with guarantee, here are our terms without guarantee, and so on. Collateral. And collateral is somehow similar because it's another security for the bank, but collateral is an asset, so it's not a person, it's an asset. And this asset, the borrower can provide to the bank to guarantee that their loan is secured. What does it mean? For example, if you take a loan to buy an apartment, at least in Russia it works like this. I'm sure that in many other countries at least will work the same way. If you take a loan to buy an apartment, then officially your new apartment will be pledged in the bank until you pay the loan back. Only after you pay everything back, you will be an official owner of this apartment. So that's how it works. It's quite the same for car loans in Russia, or maybe something else. It may be just a separate loan with a collateral, and so on. Another feature is also similar to the deposit early withdrawal, but here it's early repayment. And early repayment of a loan, it's not always possible, or it may have some specific conditions, especially for companies. And the example here is like this, that, for example, let's assume that some company take a loan for 5 years to found a project, and this project was so successful, and it earned enough cash to pay back in 3 years. But even in this case, the bank may still not allow the company to repay its debt early, because it may be like other reasons. For example, the loan was at I don't know, 10%, but now market condition changed and 5%, and of course the bank wants to keep getting high interest rates. For it may be one possible motivation. In Russia, important again feature, in Russia all individuals are always allowed to repay loans early. So here we are lucky, we can withdraw deposits early, we can repay our loans early. Here is something in the chat. Or maybe not.
There was a question about companies. Are they allowed to repay early or not?
In Russia, in general, not. So probably in other countries, it's also not. I just explained why it's maybe not comfortable for banks to do so, because they want to make the payments they're getting on some horizon more or less predictable, because other way for example, let's assume that level of interest rate dropped. So every big company will come and try to repay the debt early. So, and bank will lose all interest that it counted for. So they may just agree that the company is not allowed to repay. But in Russia, you know, individuals are considered less protected, less financially literate, maybe. So government tries to protect people in this way, at least, and allow not to worry about things like this. Did I answer your question?
Yes, you did. Thank you.
Another feature, it's quite important, and what is what is even more important is that it really affects how much money you pay back, even if you have the same interest rate. Let's consider two types of payments. The first would be differentiated payment, and another one is called annuity. And differentiated payments in this way, the principal amount is fixed in each payment, and annuity is vice versa, when the payment size is always the same, but the proportion of principal and interest may be different. I understand that such definition is probably confusing, so let's just consider an example. Here you can see two charts with two types of payments. So here is an example that of a loan of 1 million ruble for 10 years with 10% interest rate and annual payments. And let's consider the left chart first. Here is, you can see in green color, it's a principal payment, and in blue color is interest payment. Because you know, your principal amount is the initial, that's how initial amount of your investment or your loan is called. So, and interest is, when we're talking about loan, the interest keeps accruing only on the principal amount. So there could be such scheme that the principal share of your every year payment could be the same. And because you every year you're decreasing your principal, interest will also decrease. Is it clear how those differentiated payment scheme works? I understand it may be no, a lot of details, and they may seem quite I don't know, boring stuff, but the problem is that the boring stuff is what actually affects the payment we make. So I think it's quite important to understand it. So if you have any question about this scheme of payment, please ask me. And here is a scheme for the annuity payment. Then when you, in advance, you know that all your payment will be the same. So, but of course, then it means that the proportion of principal and interest will change, and it will look something like this. So the proportion of interest is very high in the beginning because you have a very big principal and interest is accrued on principal only. And the longer you go, the less is your principal left and the less is your interest. So is the difference clear for those two types of payment? Please ask if it's not.
I have a question. Which payment is more popular?
It depends on types of the product, I guess.
For example, big companies, which payment they pay?
For big companies, I'm not sure. I know that for individuals, I guess annuity is more popular. And for big companies, actually, I think the same, because otherwise it could be not always comfortable, because assume, for example, that company takes a loan to found the project, for example. And usually when you take money to found the project, you assume that it will bring money in the future, at some point in the future. So, and here the scheme assumes that the highest payment I made in the beginning. I think for most companies, this scheme would be less comfortable than this one. But for example, in Russia, for all mortgage payment, mortgage is ipoteka when you buy an apartment. We will talk about it also right now. For all mortgages, it's usually annuity payments. Which,
Переводится на русский.
sorry?
Как это по-русски будет? Annuity и differentiated payments.
Yeah, sorry. Ivan is asking about the translation of those two terms. So differentiated payments states for дифференцированные платежи, and annuity states for аннуитет or аннуитетные платежи. So it's quite sounds quite similar in Russia. It is in English. And as you see, what's important? Not important, but it deserves to notice that total payoff in the case of differentiated payments is lower than total payoff in case of annuity. And it's always like this. So the question is, if we know that the total payoff is lower for differentiated payments, does it mean that we should always ask for differentiated payments type of the loan? What do you think? Let's vote. What would you choose? Type something in the chat or use your microphone. Does it mean that you would always choose the differentiated payments type of the loan if you need to choose? No, as we talk about years, no. No, because DP can be too much for a person first time. Yeah. First of all, it depends of what is comfortable for you to pay off. For example, if you don't have money now, but you plan to have money in the future, of course, for you, it's not so comfortable to make a big payment, a big first payment right away. Yes, this is one side, but how to estimate economically? Yeah, as we discussed, probably you cannot see what I'm drawing on this part of the screen. I'll show here. As we discussed, money today is not the same as some money in the future. So yes, something in the chart again. No, because in years, yeah, exactly. In 10 years, the value of money will decrease. So we need to know more information about interest rates level, about about interest rate level, about our personal, personal schedule of income and payments. And only then we can make a choice between those two payment schemes, because this one, okay, this one is a payment later in time, but still, because of time value of money, when you try to understand how much it costs for the present value, you may realize that from the point of time value of money, it may be not so obvious. So the total payoff may be higher in case of annuity, but still, because of time value of money and because of this time structure of payoffs and difference in interest rates, it's not clear what could be more economically profitable, even if we are not thinking about what would become more comfortable for us because of some our personal situation, because I don't know, we will just got a higher income in 2 years, for example. Any questions? Okay, good. So let's consider such an example. Assume that you borrowed again $1 million in the bank and the 7% interest rate for 5 years, and assume annuity payments. You have annuity payments and they are made once a year. Let's try to understand how would you determine the amount of the annuity payment size. Let me nice. So you borrowed $1 million. And let's assume that there is some annuity payments and it's equals to X. So how to define this X? So we know that from time value of money point of view, the fact that you just borrowed this 1 million, it must be exactly economically compensated by all the future payments you're going to make. So here are 5 years. So you know that if you calculate present value of all those payments to the current moment, it must be exactly the same to you as this amount of payment you get, because otherwise you would not make it. I mean, if you, let's assume that we are completely rational and we only care about economical value, we only care about finance, and you will only take a loan if it's economically profitable to you. So it must be the case that the money you get, so this 1 million, it should equal to the present value of all your future payments. And let's think how much that would be. As we discussed, we need to use this discount rate. So in 1 year, we will pay X. And to estimate how much it is up to current point, we should probably use, it's happening all the time. We should discount our payment for 7%, and it will look like this. Remember, just like we discussed in the beginning when we discussed what time value of money is. And then the same for the second payment. But because it's for 2 years, this already would be squared. And so on. So we are just discounting each future payment to understand how much it would cost today. And to make this, we're like asking ourselves a question, how much should I borrow today? So in 3 years, I would be able to cover my debt with interest by this X amount of money. And this would be exactly x divided by this discount factor. And please, if you have any questions, please ask them. So that's how it would generally look like. And what does it look like? What does this expression remind you? Any ideas? How can we make it look simpler? Yeah, this reminds, I guess what Valentina meant is a geometric progression. And we know how to calculate the by the way, do you remember the formula of the first n members of geometric progression? I believe it must be, I'll just remind, this is just reminding for myself. It must look like something like this. Here our B1 is this one, I guess. So it would be our B1. Our Q would be, oh, it would be 1 over 1 plus 7%. Our N is I'm wondering, it's probably 4. And sorry. So that's how I guess it should look like. And if we try to calculate it more in a more fancy way, because this of course is not does not look really good. Oh, we can just multiply this by 1 plus 7%, and then we would get x, and here would be 1 minus 1 plus 7% in the power of, okay, I guess it must be 5 here in the power of minus 5, because here I had 1 over 1 plus 7%, and here I already using 1 plus 7%. And here we will just have 7%. So, and if you want, you can just calculate x from here. It would be x equal $1 million divided by this expression, 1 minus. So if you can, please calculate, but I know what we should get. So this is just a reminder for myself and for you to check if you want to go into details and repeat those calculations. This is the answer we are supposed to get here. And if just in case you calculated this and you got it, please let me know that it is correct or not. Okay, any questions here? Okay, no questions. Can I erase?
I'm sorry, I have a question, maybe a stupid one, but did you talk about how to calculate an interest rate? I don't understand how to calculate, how
Sorry,
to understand what does it mean.
what do you mean? Could you please repeat the question? I'm sure I didn't get you. Just could you please repeat?
I believe the question was about how to calculate interest rate, because we know that the key interest rate is set by central banks, then the commercial banks, they add some risky like component to that key interest rate, and they get their interest rate, which they use when they like lend money, right? So could you please explain about this process? How do commercial banks get their interest rate?
Sorry, Remilia, is it a good explanation?
Yeah.
Yeah.
How to calculate an interest rate?
From the point of view of client, the client just come and ask a bank what would be the interest rate you would offer me, and bank just say some number, and so when you're a client, you just get the number. If you're a big client, very significant client, you may negotiate and ask, for more beneficial condition. But in general, you just know it's fact. When you are a bank, yeah, as Ivan, I believe, said it, there is a complicated way of defining the right interest rate, but bank just usually goes to the market, and let me change the color. I hope I will not confuse you if I write it right here. It goes for the market and, for example, looks at this data. The bank is considering if the bank itself wants to be a client for someone else. For example, if the bank wants to attract money, to raise money, or to deposit money somewhere, what would be condition for it? For example, if he would like to do this for 1 day, the market condition would be like this. For example, if this would be for 1 month, it would be like this. Why is it happening? This interest rate for 1 year, for example, here, and so on. And here is he will go. The bank will get so-called interest rate curve, which is an inner for the bank itself, because for in the market condition, like in theory, it's all the same. It's all perfect for all financial market participants, but in reality it may differ a little bit. So each bank may go to the market, to other banks, to the central bank, and to estimate somehow average condition that that are available to the bank. So here would be the term, and here would be interest rate. And this is what bank has for itself. But the bank is a commercial organization, right? It must earn money. It must make profits. It must also account for some risk. And yeah, as Ivan correctly stated, the bank is trying to estimate risks. It tried to estimate how much it wants to make. Also, it makes the same for all different currencies. So if and for example, here the bank defines its own deposit deposit interest rates. Sorry, write it here. Here would be, for example, level of deposit interest rates defined by the bank. Here is market, which the bank starts from, and again, accounting for risks and its goal for profits and so on, the bank would also define the interest rate of loans for different terms. So did I answer your question?
Yeah, I understood that it's more complicated than I thought.
Yeah, it's actually a very complicated process. There is like a whole department working on this. It's not so easy to account for everything. So, but in general, it's a general idea. So, of course, when you're client, you don't have to, think about all these complicated processes. You just need to know that the bank looks at the market, and starting from the market, it estimates its own specific risks, its own specific goals of profits, and decides on the final product's interest rate. And as a client, you'll probably just see it as a fact. So you definitely won't have to worry about this process. Any other questions on this part? Okay. We don't have anything in the chat. Okay, let's continue. And so here is a final formula of annuity. It's quite useful. You probably, maybe not all of you, but at least I guess most of you will face the annuity payments in your life. So you may be interested in how it's calculated. This is a general formula we just used in a previous example. Here is one important moment to remember when you're trying to deal with loans. Apart from the loan interest rate itself, you may be also required to pay for insurance. Insurance is such a thing that bank asks you to pay for in case something happens to you. For example, you die, I don't know, you are in some accident, and in this case you default to pay. And the bank, of course, they don't care that something happens to you. They care that you will default to pay. And for this case, banks may ask you to buy an insurance. And this is in general, I mean, it sounds reasonable from the bank point of view. But unfortunately, sometimes it may be a surprise for a client. So as this is the financial literacy course, so I need to warn you. So be careful, because banks often announce their interest rate. They not the insurance payment you will be obliged to pay. I'm sure it's at least, I don't know, at least 0.5% of cases you will not be mentioning, you will not hear about this before you come to making a deal. So, for example, and this is a real example, which I'm sure it happens all the time, but this one, it happened exactly with a friend of mine. One day, just I changed the amount of money, but the nature of the problem is the same. So the bank offered her a loan, made an offer of 10% interest rate, and so as she was young, she signed the contract without reading it too carefully. At least there are a lot of complicated stuff. So so she agreed for the contract, and then she was said that she need to pay additional 15,000 rubles or so, like at least some substantial amount of money for the insurance. And if you do not agree to pay to the insurance, your interest rate will change like significantly to the above. So in this particular case, the initial offer was 10% interest rate, and if you refuse to pay on the insurance, your interest rate will rise more than 2%. So this happens quite often. So I may be quite sure that if you will be taking loans from time to time in your life, I know for many reasons it may happen. So me personally, I do not think that this is loan a bad thing. At least for people like I'm sure most of Skoltech graduates are people who are responsible, who can control their desires and so on. And if you need it for something important, then why not? So I'm quite sure that at some point of life, if you take loan, you will hear about insurance and you will probably remember this story. But be careful and do not agree for anything before you ask how about insurance payments. So credit history and scoring. This is also about loans, as you understand. And I was also, before the course, I was asked by someone about how credit history is important. And yes, credit history is important. And what is a credit history, essentially? Credit history is a record on each potential borrower of the bank or any other financial institution. And it could include things like if the individual has currently open loans, if this individual ever missed loan payments in the past, and for example, if this individual has some other obligations, like in this case, the child payments, or maybe some utility payments, or some bills that he or she did not cover. If there were much of previous requests on this person credit history, how often does this person apply for loans, and so on. So it's quite, quite a check for the history. And here's a question in the chat: if you use credit card, doesn't count as a credit history? Yes, this is also your obligation to to pay, and if you miss it, then it will probably get to your credit history. It's commonly considered that probably if you just, I don't know, miss one day, it does not affect much, but still it will affect badly. You mean, if you mean that you just using credit card, this is probably okay. We will talk about credit cards hopefully today. And there is such a period on credit cards when you also start having interest. And if you're missing those interest payments, I guess this is not a good thing for credit history. And just the fact that you are using credit card, I think it's absolutely okay.
May I ask a question too?
Sure.
What if I don't have any credit history? Does it mean that I'm a good borrower or not, or what?
That's a good question. It doesn't mean that you're a good borrower. So actually, the banks, they would prefer a person who takes loans from time to time and pay them very well. And if you do not pay, if you do not have much of credit history, so you are like, shorting your cat because they do not know in advance what to expect from you. So that's how they think of it.
Yeah, thank you.
But of course, not of course, maybe it's not so clear, but this would be reasonable to assume. I think you'll agree with me that no credit history is better than bad credit history. So that's for sure. Here's a question in the chat. Are we going to take a break? Yes, I think so. Let me check, like to come to some point, to some logical point, and we will take. Let's finish with credit history and scoring. So, what is scoring? Credit score is like a total measure of how good is this borrower for the bank, and every bank, every financial institution has its own scoring policy, has its own scoring models, and your credit score directly affects what would be the bank decision on your loan. First of all, if the score is not good, they may even refuse to provide you a loan. And even if they agree to provide you a loan, it may affect the interest rate. So this is kind of an important thing. And as I also had this question previously, in other countries, for example, the United States, people talk about a credit score, at least as I know, quite a lot. So everyone know what's going on with their credit scoring. Everyone is caring about his credit history, and in Russia, it's not exactly the case. But the fact that we are not talking about it and the fact that people are not aware about it doesn't mean the banks do not care about it. So trust me, even if you have no idea what your credit history is and what your score is, I mean, you cannot check your score in advance. It's a matter of banks. They use their own models. But still, if you do not care about your credit history and so, trust me, the bank does care. And if you come to a bank, they will check your credit history and they calculate your own credit score. So what credit score may account for? Of course, credit history. If you don't pay loans in the past, it will affect badly, of course. It may also account for your age, for your marriage status, for your family status, if you have children. It must account for your income, for your occupation area, and for your experience, which means that how long do you work at the same place. Also, they will collect all information they can find you from the police, from the tax office, from the pension fund. Pension fund is important because pension fund gets money from the company you work for, and pension information allows to understand if your income is real or not. From the tax office, from the if you had any court cases and so on. And actually, even according to the Russian Central Bank official information, sometimes many banks even check social networks. It sounds, I believe it, I can't believe it because now it's everywhere, and why not banks use it? And as I said, different banks use different scoring models, so you never know. But in general, those I think you should look at when you care. The question in the chat, is it good for credit history to be married? Yes, definitely. This is a good thing because probably they consider you as more responsible, or you, I don't know, it would be more trouble for you to run away if you have a family. So the bank consider married people better borrowers and more responsible borrowers than people who are not married. And maybe that's because also usually it may be that two people in the family have income, and for example, if you lose your job, your wife may have a job and help you, and vice versa. If she lost a job, you will pay her loans. So yeah, the marriage status is definitely a good thing from point of view of the bank. So okay, let's take a break for 15 minutes here, and we will continue at 11:51. So see you in 15 minutes. Okay, I think I can continue. And while I was on a break, I remembered a recent story of mine when I prepared this slide on the credit history, and I noticed that they also look at previous loan application. Uh, and I just remembered that this year in online bank application, I saw that there is a button that you can ask for a loan, and I decided just to check, just in case. So I didn't need money. I just decided to check if they wanna lend me like the maximal amount that is allowed to ask for, which was like really big sum, and I just pressed this button like 15 times in a row, and I got rejected 15 times in a row, and now I'm wondering how it probably affected my credit history. So I probably have now 15 more previous loan applications, and they're all bad. So be careful. uh, I hope that it does not affect much, your future, but still, according to this methodology, just pressing buttons in online bank may be a devastating thing, at least a little bit. Okay, let's continue to the next topic. Not actually the next topic, just a specific case of a loan, which is quite often mentioned everywhere. Many people have it. It's mortgage. Mortgage is a type of loan which you take or to buy a real estate, so an apartment, house, and so on. And their main feature of such a loan, um, first of all, it's usually a very big amount of money, uh, especially if you're like in a city like Moscow. Usually, apartments are very expensive, and this is not just some amount of money that the bank would be willing to give everyone just because they want to buy an apartment. So to secure this procedure, the bank usually requires, not usually but always for this type of a loan, at least in Russia, uh, to secure this loan by the property itself. So until the borrower pays back the total amount of mortgage, the apartment or house officially belongs to the bank. Not exactly belongs, like from the law point of view, it may be not exactly correct to say this, but the bank also has rights to this real estate, and you usually cannot do anything. You cannot, I don't know, just sell an apartment. You cannot rearrange your apartment, uh, many other things. But on the other hand, this procedure allows bank to believe you and to give money, because just in case they're secured with this apartment. So mortgage. Another thing that that often happens in a bank, it's called letter of credit, and in Russian it would be аккредитив. I wouldn't be surprised if you hadn't heard much of it, because it's an unusual word, and I don't hear it much just everywhere. But anyway, it's not a rare product. It's quite a common thing, and it's usually used to provide a payment mechanism between the buyer and the seller when there is such a usually when there is a big amount of money, for example, for an apartment. And also those letter of credit, it's quite popular in the international trade. And here is why. Assume, let's consider this example. Assume that you found a car you want to buy, and a car is an expensive thing, and you're maybe afraid that the seller might just get the money and disappear. For example, especially if the seller, for example, he must come from another city to give you the car, for example. So of course you may be hesitating that you'll send the money and the seller just doesn't give you the car. And at the same time, the seller may have the same hesitation about you. And the question is how to organize the deal if no one trusts no one. So here is such a banking product as letter of credit. In this case, the bank acts as a third party for some commission, and usually the bank blocks money in your account in such an example, and the seller will only get the money when he or she proves that he indeed gave you the car. So at the same time, you cannot have money back if he proved that he did indeed sold you the car. So this is how this letter of credit works. It just secures both party of the deal, and to make it more risky, it makes it all less risky for both parties, so it can be comfortable. And I said that it's quite common because I know that many transactions when buying an apartment, including those with a mortgage, it's at least in Russia, it's made with letter of credit. So, practical question. And the question is, assume that you found an apartment of your dream and you have enough money to buy it. Maybe if it's not the case now, it may be in the future. So, and you have a choice. You buy an apartment for 10 million ruble now, or you rent the same apartment for, say, 40,000 ruble per month forever. And let's assume it's like this. And what should we choose? How would we choose? So first of all, as we already know, we would need to define the interest rate, and the interest rate, assume it's 10%, and it doesn't depend on the term. And we already know that we need to calculate present values of all future payments and compare their present value. Again, let's assume we only care about economics. So here are two options we need to compare. The first option is to pay rent right away, and another option is to pay 40,000 rubles forever. Like, I don't know. Why forever? Because, for example, if you have children, they could be living in the apartment that you bought, but if you didn't buy it, then they will continue paying rent, and then your grandchildren and so on. So that's why assumption about forever is not completely crazy. Of course, in reality, it may not be the case, but let's consider the mechanism. How do we approach this? In this case, we would, as I said, I will not calculate it like super precisely, but we would have to calculate sum, which would look something like, okay, something like this. It would be 40K like now, it would be 40K in 1 month. So in 1 month, we would have to divide it by the interest rate. And interest rate, as you remember, it's always stated in annual terms, and our payment is every month. So we would have to divide it for 12 months. Oh, when will I learn? And then the same thing for the second month. Oh, sorry. And so on. And this is like forever. I see something here in the chat. What is the interest rate in this situation? I mean, there is no loan here. Yeah, that's a good question, actually. I skipped it to avoid complications, but probably it would be more correct to say it like this. So in this case, we would have to consider is so-called cost of money. If we would like to get money from somewhere, how much interest would it cost? So in this case, when we are talking about apartment, the good example could be, of course, the mortgage interest. And it's not completely like this. So in reality, if you would be calculating this, then of course, interest rate would not be 10% for each month. So for different term, it would be different. But in this case, for simplicity, we assume that it's 10% as for mortgage, as for everything else. So remember when we discussed how to estimate the present value of those 40,000 you will have to pay in the future. This would be how much is 40,000 for you in 1 month. This would be how much you can borrow today to be repaid in 1 month, and to cover this amount with interest exactly with 40K that you will get in, or in this case, you will pay in 1 month. So, so this rate would be a marginal, so-called marginal lending rate. So the rate at which you can raise money if you would like to. So in this case, if we assume that mortgage rate is 10% and all interest rates are 10%, that would be 10%. But in reality, you need to be careful with this if you want to go into details. Something in the chat. Okay, good. So the expression would be something like this, and like forever, and this is again geometric progression, and this would probably be something like, it would probably be something like 40K divided by 1, something like this probably. No, it sounds a little bit weird. So why? Because it's 1 minus. Yeah, that would probably be more correct. So I forgot that the sum of infinite number of geometric progression with a curve Q looks like this. So it's 1 minus Q, not just Q. So that's how would you consider this question if you needed to. Of course, every time you would need to check what is the level of interest rate. And here, what would you get? So here, it's how much it depends on the interest rate level. So here in blue, you can see the apartment price. It's always fixed. No, for now, at least. It does not depend on the interest rate, you know. And here is how present value of all future payments, if we assume they will be infinite, how this present value from this economic value for today depends on the level of interest rates. So you see that for 10%, it at least half more economically profitable to rent an apartment than to buy it. And this 0 point is somewhere around 5%. If the interest rates in this example were around 5%, economically, it would not matter for us if we need to buy or rent an apartment. And the same thing, actually, you can ask the same question about cars. For example, is it profitable to buy a car or just to take a taxi all the time? And you would you would probably get that taking a taxi is much more economically, much more economically reasonable. But of course, in reality, people do not buy apartment or cars just because they want to be economically reasonable. There could be other psychological differences, maybe about stability and comfort and so on. So, but if we care about economics, if we make any decision, we need to understand it from different sides, and from economic side, probably. As for now, I think renting an apartment would be less beneficial than buying it. Of course, these are not current real data, so it doesn't mean that on current market data it would be the same. Again, you could, for example, limit if you're going to live, I don't know, 60, 70 more years, you could limit it not to infinity, but probably to some limited number of years. But I guess on real market data, it would be still much. And apartment prices in Moscow, at least, it's definitely not 10 million. It's, I think, on average, it's higher, at least for those apartments which cost 40,000 per month. Okay, any questions? No? Okay. Another question is taking a loan when you have money. Does it make sense? Assume again you're about to buy an apartment. So you made your decision, you're about to buy an apartment. Do you think it could be economically reasonable to take a mortgage even if you have enough money to pay it right away? Please type in the chat if you have any thoughts about this. So could it be economically reasonable to take a loan even if you have money? And this is an important question. It demonstrates, as we will see, it demonstrates an important concept. It depends on inflation rates. Oh, okay. Any other ideas? We should calculate, maybe it might be more reasonable to buy currency to save our capital and pay in rubles. I would say intuitively it's better to buy now, and if you can make money from. Yeah, Anna. Anna's question is actually the best one. Is it correct? Confidence in future income. Yes. Yeah, confidence in the future income is also important. Of course, if you are not sure about your future income, but on the other hand, you have money right now, and if you keep them, you can pay anytime later. But the main idea is that actually, yes, the answer could be that it could be reasonable to take a mortgage if you're already comfortable, with all this investment stuff, and or maybe you have a partnership with some asset manager or some fund who manages money for you, and you just understand that you see some opportunities where you can put your money. So you don't have to, you just can do it. And you expect it to bring you a higher return than you will have to pay for the mortgage. In this case, it could be economically reasonable to take a loan even if you have money. But of course, there could be other, reasons. Psychological, you're not confident about the future, you may not be comfortable, with taking an investment risks that you'll put money somewhere else and maybe something happens. But if you like completely rational, you don't have emotions, or you have emotions but you're very calm, then it may be reasonable to do so. Thank you for your ideas. Here is one important concept that you need to be aware of, and this could cause problems. This is called foreign exchange or FX risk. What is this? Is the risk of bearing a loss because of foreign exchange rate changes. Let's consider an example. The situation from the left is one situation, the situation from the right is another situation. Let's assume that there is just some hypothetical family, and this family this has income of 70,000 rubles, and it also this family has to buy food. Okay, they have children. I don't know. They cannot starve. So, and let's also assume that this family decided to take a loan in US dollars for some reason. So for now, if the current rate is USD to ruble is 70, then for now, their regular loan payments of 500 US dollars would be equal to 35 rubles. And they have exactly balanced budget for now. So the value of their assets equals the value of their liabilities. And that looks like okay. But let's consider example, if there is another economic crisis, I don't know, you never know, right? So maybe tomorrow the ruble will drop again, maybe twice. So let's assume that something bad happened. It's already bad for the economy in general, but how it can affect this hypothetical family. Because if US dollar price in rubles grew up twice, then the loan payment of this family, which is in US dollars, will also grew twice. And family income, it stays in ruble. And, you know, in this case, liability will substantially exceed the value of their assets, and this family would be in real trouble. So is it a clear example? Do you have any questions? Is it possible to take a loan in USD in Russia? Yes. Both as deposit and take a loan in US dollars. Okay, no questions. So I hope this example is clear, because it's quite popular and could be really devastating. So it's important to understand what is foreign exchange risk, especially in this example. So this is another example, and it's absolutely the same nature. Another question: why is it popular? Why is it popular? I'll show you the example in a couple of slides. This example, it's called foreign exchange risk for companies. The picture is completely the same, just the sums are different. I just wanted to emphasize by this slide that for companies, this problem is even more relevant, because, you know, if you live, for example, in Russia, you don't have much problem, you know, to survive just using your national currency. So it's hard to imagine, maybe it may be the case, but still, usually most people, you know, they can't handle and live without any foreign currency. But for companies, it may be often not the case. For example, if the company have some international partnership and maybe they are buying some components, something they need. For example, here, I assumed some biomedical startup in Russia, which regularly has to buy some important chemical components abroad. And for companies, this is maybe crucially important to account for exchange rate risk, because it may be the case that this component of importing stuff, it's usually paid, of course, in foreign currency, in US dollars or in euro, that it may suddenly grew up in price relative to the ruble. and it could cause real troubles for the company. And actually, it always happens during all economic crisis. So if I know that many people come to Skoltech hoping to, I don't know, build some company, to build a startup. So I'm quite sure that some of you will probably be facing some FX risks. So it would be a good thing if you remember about such a problem and would try to manage it somehow. So example from Russia, why I'm saying this is popular and why it's not, it's getting not so popular now. You know, as we discussed yesterday, the interest rate in Russia is higher than in other countries. In US dollars and in euro. And earlier, the interest rate in ruble was even higher, and interest rates in euro and US dollars were always, at least recently, they were always quite low. So, and it happened so that in the beginning of 2000, many people in Russia were attracted by low interest rates in mortgage in foreign currency. And mortgage, as we just discussed, is a huge loan to buy an apartment. So it could be like a very big amount of money. And also, as you probably know, later there was an economic crisis of 2008 and then another one in 2014. And during those crises, ruble lost more than half of its value. And let's now imagine how it affected those people. So if they had income in USD or euro, they would not suffer much. But most of those people, they had income in rubles. So, and exactly like in this example, they had real trouble when their loan payment, and this is not this was not just one-time thing. You know, mortgage is usually it's for a very long time. It could be, I don't know, 20 years, 30 years, and many of those people, they really suffered a lot. And that just because those people, they thought, okay, there are lower interest rates, I will probably have to pay less. But those people, they didn't account for the foreign exchange risk they may bear. Maybe they just didn't know, maybe they just didn't think of it, but eventually, you know, it happened like this. And this is a picture of one of many Russian protests during those events. And this picture of this guy says that foreign currency mortgage is a slavery of the 21st century. And protests with the black balloons were popular all over the Russia because many people really suffered from this. And after this, I believe maybe like 6 years ago or something like this. Okay, I'm not sure, but several years ago, because of those cases, the foreign currency mortgages were actually forbidden. It was forbidden to banks to provide foreign currency mortgages to individuals. And so now this problem, you know, it goes down, but in the beginning of the century, it was quite a big problem because many people was not able to pay their debts. So the crucial point is that it's risky to borrow a lot of money in a currency which is not the same as the currency of your income. And this is a very vivid example of this concept. And actually, it's not only a Russian problem. In many emerging markets, and emerging markets, as we discussed yesterday, markets which are not like completely, which are far from being efficient, but they already have some infrastructure. So in emerging markets like Russia and Eastern Europe, like Brazil and many countries, you remember they were blue in the map picture yesterday. And in many of those countries, interest rates are higher than in developed countries' markets. So, and many people not only in Russia, were attracted by those mortgages. And here is a picture from some Western Europe. I'm not sure, it's maybe Poland or Hungary, where many people took loans in Swiss francs. You see the CHF sign, also because of low interest rate, and they suffered just like people in Russia, maybe in some other year. Okay. And it's not only for individuals. So not only individuals want to have lower interest rate and do not think about the consequences. The major example from media, it may be the case that you heard of it. If you live in Moscow, or if you've been to Moscow, you will probably recognize this famous building. This is just of one of many buildings of its kind in terms of finance. So this office building is famous for its shape, and now this building belongs to Sberbank. Maybe you heard of it. So, and the former owner of this building was also attracted by low interest rates in sorry, in the chat. Okay, I'll comment on this. Okay, the owner of this building was attracted by low interest rates, and then, of course, not of course, but no surprise, this owner went bankrupt during the last ruble crisis in 2014 and 2015. So, and this owner also took a loan in Sberbank, and now this building belongs to Sberbank. And actually, there are many, really many buildings belonging to the major Russian bank like Sberbank and VTB Bank. And that is why actually those two banks, for those who don't know, Sberbank and VTB, they are like biggest Russian banks, and they cover almost like, I don't know, almost all the Russian market. And those two banks are now the biggest owners of real estate in Moscow, at least. So the question in the chat, what should one do in this situation? If one has loan in USD and he is witnesses the ruble fall, so I don't know, first of all, you know, the purpose of this discussion is probably that you would realize that it's better to think before you're taking the loan. But if it's already happening, I don't know, I can just say what I think. I guess there is no universal way of action. But maybe if you think that, if you see that situation is getting unstable, you should probably go and change your loan to your national currency, to rubles, or to wherever you live. So at least you know you can stop it early. It's better to bear small loss, you know, than to continue waiting and to bear a big loss. And as we discussed, if you live in Russia, you can always repay your loans early, and so no one can stop you from repaying your loans and converting into rubles. My parents were in such situation in 1998. Yeah, exactly. I know that, especially in the 90s, because people were even less aware about such risks than they are now, and many people also suffered in 1998, where there was economic crisis in Russia. So, yeah, that's possible. So another question: is it possible to change loan currency? It is possible. It depends how you negotiate with the bank. It's not just like, you know, they change it. They actually, maybe you cannot see it, but they also, you know, they would have to open a new loan for you. They would have to buy currency on those money, you know, to pay off your old loan. Maybe you will not see it, but this is what actually happening if you just change the currency of your loan. It may be also the case that your bank will not agree to do so, and you may just go to other bank and to actually probably no. I cannot imagine how it can be the case that your bank can say, okay, we will not do this. Yeah, they probably cannot refuse it. But you may also go to another bank and also ask for loan in rubles here. That's actually what I did. I was one of people also who had loan in foreign currency in 2014, 2015. But I had quite a special situation. I had to pay for my education in US dollars, and I kind of didn't have a choice because I didn't have money to pay. And I had already an agreement of a bank with my university that they provide such loans. So I didn't care. And it was not such a big amount because it was not actually, it was, my education was free, but my living arrangements were paid in US dollars. And since that, they decided that it's time to change it, back to safe currency. So, and why I'm telling this story? Because yes, when I graduated and then I got the job, the first thing I did, I just went to a bank and asked to, took in another bank, I took a loan in rubles, just converted it to myself in US dollars, came to a bank with such a envelope of money and say, okay, this is money for my loan. So, but actually, when I was taking it, I was not even aware of such thing and that they could happen. So now I would probably still have no choice in such situation, but still, at least I would know what can happen. Okay, that's it for foreign exchange risk. Do you have any question on this part? Okay, let's continue to plastic cards. Here are two major types. In this case, it's three, but two major types of cards everyone knows. The first one is debit card, and a debit card is just probably almost everyone in the 21st century has it, in Russia at least. And debit card provides access to your current money. You can transfer money, you can make purchases, so it's quite clear. With credit card, it's a little bit less clear. Credit card is a product which provides you an access to a bank's money. So you may not have your own money, but you may just ask bank for the credit card, and you will just pay with it where you want, and just pay back in some time. And the important feature is that most credit cards have such so-called grace period. It's usually about like 30 days, maybe a little bit longer. And the grace period is the period when you pay nothing for using the money. So you just use bank's money and you pay nothing. So, or very little, like much less that you would pay for a loan, for example. But you may ask, what's the point, right? What's the point for the bank just give you money for free? The point is that if you miss the payment after the grace period, that you will be charged very high interest rate. And since many people do so all the time, so eventually the bank can earn money. And very high interest rate, it could be like, I don't know, 30%, 40%, it depends always on the agreement. Yeah, that's how credit card works. Also, credit cards, by the way, they can be useful. We'll also talk about it probably tomorrow already. They can be useful if frauds acquire your card somehow and get access to your money. That not your money, the bank's money, because they get access to your credit card. Then you will bear no losses At least in Russia, it works like this. I guess in most countries it must be the same. So if something happens to your money, this is the problems of your bank, not your problems. But if the frauds get to your debit card and spend your money, for example, this will be your problem. So if you want to protect from frauds, from robbery, you may you may get a credit card for yourself. And the third type here is overdraft card. It's something between the debit card and the credit card. When you have money, it looks like usual debit card. You just spend money. You can, you have access to your current account. You make transfers and so on. But then, if you don't have money and you want to buy something, you may how to say, go to a negative balance. So you may, like in this point, your card returns from the debit card to credit card, and you may go to negative balance. And in this case, this overdraft card would also have this grace period as for credit card. And if you miss payments, you will probably also be charged a very high interest rate, or your card will be just blocked. What could be features of plastic cards? By the way, okay, it's okay. We still have 25 minutes. What could be features of plastic cards? First of all, they may have different payment system. What's payment system? Payment system is the company which organizes all this payment transaction. So we don't have to worry about it. The most known in Russia, I guess, Visa, MasterCard, it could be American Express, it could be UnionPay, and of course, our Russian payment system, Mir, which is translated to English as peace, which was developed quite recently, maybe, I don't know, 6 years ago, 5 years ago, when all those foreign sanctions against Russia happened. Russia decided to develop its own payment system in order not to be disconnected from those systems. I mean, in case if Russia would be disconnected, they would have its own payment system. Also, another feature of plastic card could be a commission. You should pay attention, and it's probably not even a feature of the card itself. It's more like a feature of your agreement to bank. And ATM commission can be probably, yes, feature exactly of a plastic card. Another feature could be different type of limits. It could be how much money you can withdraw at once, how much money you can withdraw in one day at maximum, how much money you can transfer in one day, how much money can you transfer without commission, for example, how much money you can go negative, or what is your credit limit. So different type of limits. There is also such thing as cashback, which is getting more and more common for different cards. And what is cashback? This is the thing when you pay with your card and you may get some money returned to your card. It may be in the form of money, it may be in the form of bonuses. For example, I bought something in the supermarket every day, and in the end of month, I may get, I don't know, 2% of the money I spent back to my card. Why this is happening? Because my bank is actually earning money on organizing those transactions, because the seller of the supermarket. So the supermarket, when I pay with my card, they have to pay for so-called acquiring. Acquiring is a service of exactly those electronic payments, of making all those transactions, because they still have to move money somehow behind the scenes, so we do not see it, but it's happening. So, and our banks usually earn on this, and they want to attract customers, so they are ready sometimes to share to share these profits with customers just in order to keep them. So sometimes it may happen just in a way of bonuses. For example, they may provide you bonuses that you may spend in a specific shops. For example, for a long time it was quite popular that in Sberbank they have such you know, a little bit some kind of bonuses. It's called Spasibo от Сбербанка, where you can buy burgers almost for free and Burger King and so on, something like this. Okay, also service fee. Most cards they require you to pay service fee, and the service fee obviously depends on the set of features that you've chosen for your card. And as for credit cards and overdraft cards, also you need to check the grace period length. Okay. Okay, here that's it for plastic cards. Another type of product is insurance. Insurance, it's quite intuitively clear what insurance is, but just in case, insurance is when you pay money to be paid much more money in case of some unpleasant event. For example, there is some major type of insurance, for example, life insurance. If something happens to you, your family will have a very big payoff if you buy life insurance. Health insurance is when you get paid, not you, but you don't have to pay in a clinic. If, for example, you get sick, I believe all Skoltech students have the health insurance in Skoltech. So this is exactly the kind of the product. So it means that Skoltech paid to some insurance company, and this insurance company pay for us every time we go to one of the clinic. Real estate insurance also quite popular. It's in case if something happens with your house, for example, it gets burned, or if there is some earthquake or something like this, you may be paid if something happens with a house or apartment. Also, car insurance is quite popular. I believe, at least in Russia, it's obligatory to have a car insurance. I don't know how for other countries. Okay. And why I'm telling about the insurance? Because here is such an example. Let's consider such a situation. Let's imagine that one person called Maria, she comes to the bank because she finally has enough money, and she comes to bank to learn what deposit options she has. And when Maria goes to the bank, she knows that interest rate level are currently around 4%, which is currently exactly the case in Russia. And let's imagine it may happen, and it happens actually all the time. The bank manager may start offering different things like, please try our new product. And it may exactly say things like, it's just like a deposit, but you get an insurance and your income is going to be higher, and your money will be safe, and your income will be up to 7%, for example. And and Maria knows that average is 4%, and here it's 7%, and your money will be safe, and you get insurance, and it's just like a deposit. So sounds really nice, and let's assume that Maria agrees and signs a contract, say for 3 years. 3 years, and there was, of course, a lot of complicated stuff which was hard to understand. But the main thing that she got, that she gives money and she gets something back. That's it. Let's now discuss what actually happened in this situation. It may be many things, but let's discuss the situations that I imagined when I made the slides. That Maria actually just bought a complicated product, which consisted of several parts. Part of this product is actual deposit. Part of it is life insurance. Yeah, life insurance, quite unexpected to get in a bank. And the third part of this product could be so-called currency option. So, what is for life insurance part? If Maria dies, which is not likely, because she's 25, and if she dies during this term, her family will get a payoff. If Maria is alive for 3 years, which is possible, then which is very probable, then life insurance actually she doesn't need it. So, but then she just gets a payoff on a contract according to other parts of this complicated instrument. And these are deposit. The main thing is then the manager may say, you get the insurance, and you think, okay, my money insured. But the truth is that in such situation, you may be actually offered the life insurance. So this insurance was not even about the money. It was life insurance. So it's quite misleading, but it happens quite often. So deposit. It may occur that the guaranteed deposit part has interest rate of almost 0%. And another part is the option. It may be the case that in this product there is an embedded option. What's option? It works like this. If ruble-dollar exchange rate is higher than 100 in 3 years, then Maria's deposit interest rate will rise up to 7%, depending on how much higher than 100 it is. So the option is something which value is growing according to the value of the exchange rate. So if this happens, and it's very questionable how likely that the US dollar will cost more than 100 ruble. But if it happens, then in the best case for Maria, she will get 7%. Or even if it's lower than 100%, then the option is not active, and Maria just gets this guaranteed 0.01% interest rate, which is not attractive. When you know that the average is 4 and you get 0, not cool. Also, important thing is when you buy those complicated products, you may not be even making a contract with the bank. You may be making a contract with the actual insurance company. And in this case, and in every case when you buy some complicated products which are not deposit, which are not just a simple term deposit, your money are not insured by the government, as it is in case of term deposit in Russia, at least, as we discussed, right? Up to 1,400,000 rubles, all individual deposit are insured. But in this case, as soon as Maria agreed for some strange product, if something happens, her money are not insured by the government anymore. And also another feature Maria just lost is in Russia, you can access your money and withdraw your money back if you need them any point in time. But as you agree for some complicated product, it's your responsibility that you will not have Maria's responsibility that she will not have access to her money even if she needs them. And for regular deposit, as we discussed, in Russia, you can withdraw your money anytime. You will just lose some part of the interest. So this situation is not probably not what she expected when she bought this product. And the bad thing is that this happens all the time in Russian banks. So this event, this this thing is called mis-selling, and there are like a really a lot of different types of such complicated structured products, and those products may at first look like a regular deposit. The manager may say that it's just like a deposit, maybe because she or he just doesn't understand it herself, maybe just because they just want you to buy. And the second option, as you understand, is much more likely because they get paid for this. These complicated products may consist of different things like insurance. It may even depend on some shares. It may you may be signing actually some pension fund contracts. It may depend on currency rate and as in Maria's example, some commodity price or gold price, silver price. So it can be, I don't know, whatever you imagine. And the problem is, another problem is that it can be much worse than in our examples that we just considered, because in this example, at least Maria will get eventually her money back, maybe even with almost zero interest, but still, maybe only in 3 years, but still she will get the principal amount back. And sometimes it may be worse with such products. Worse, I mean, much riskier. So you may earn money somehow, and you may lose as well. And this mis-selling, it's not officially illegal for now in Russia, at least. But this is de facto, of course, it's a misleading, it's a deception, and you should be aware of this because at least now it's right there all around us. And I know personally several cases when it happened with some people who just, I don't know, especially with people who are like, young people, they always, can check something in the internet and so on. And with older people, if you have some relatives who can go to a bank and ask for deposit, just warn them that such thing could happen because it happens all the time. So the bad thing is not the product itself. I mean, in some way, it's a good thing, you can have any product you want. But the bad thing is that they make a person who doesn't understand, who clearly doesn't understand what he or she is buying, and people do not understand what risks they're taking, what is the structure of this product. So this is a bad part. So be careful. How you can avoid it? First of all, I think it would be useful to study all different features of those insurances, of those deposits. For example, if you know that in Russia all deposits are insured by government, and you know that, for example, you can withdraw your money anytime, you already know that you're changing it for some new product, you're losing those options. So that's an example of how learning may help avoid this mis-selling in the future. Because if you don't know about it, you may not even think of it when you agree for something like this. And maybe obvious advice, but still, if you're offered some new kind of product, do not immediately agree. Take your time to better understand, to ask questions, because that's their job to answer them, to make a reasonable choice. And of course, be careful and read everything carefully. And that's it for now. For this banking part. As for your home assignment, I will upload today. It's not there now, but I'll upload today simple quiz in Canvas on banking products. And okay, do you have any questions?
I have probably a question not related to the material, but to like, I don't know. Will you increase the amount of places on this course?
Actually, I asked yesterday education office about it, and I haven't seen what they answered me yet. So I will see what they answer, and I'll let you know. I just didn't check my email, my Skoltech email today yet. But I asked them. Yes, I think they will agree because they asked me to do this already once.
Okay, thank you very much.
Any other questions? Okay, then thank you very much. I'll upload this short quiz for Chrome assignment today. And if you have any questions, please feel free to ask me. In Telegram chat or something. So thank you. See you tomorrow, I guess.
Thank you. See you.
Thank you.
Thank,
Thank you.
thank you.